Picture this for a second. You're at the helm of a massive corporation. Everything is absolutely humming. Operations are smooth, the team is crushing their targets, revenue is climbing. And then out of nowhere, bam, a geopolitical crisis hits and global fuel costs spike 50% literally overnight. Or maybe a sudden shift in monetary policy causes the primary currency you do business in to completely tank. I mean, these aren't just wild hypothetical scenarios, right? These are the terrifying, very real business uncertainties that keep executives tossing and turning at night. So, welcome to This Explainer. Today, we're arming you with the ultimate executive survival guide. We are going to master financial hedging, which is basically the corporate shield that the world's biggest institutions use to not just survive, but actually thrive in the middle of total market chaos. Think about it like this. Just as insurance protects you against unpredictable accidents, hedging protects your business against unpredictable market swings. Take your car insurance, for example. You pay that premium every single month, but you aren't doing it hoping you get into some massive wreck just so you can turn a profit on the payout. Obviously not. You buy it purely for protection. If the worst happens, the payout offsets the cost of the damages so you don't end up financially ruined. Well, financial hedging operates on that exact same logic, just applied to market disasters. All right, let's dive right into this. Here's our roadmap for today. We'll kick things off with hedging basics, then we'll compare hedging to speculation. After that, we'll look at some real-world corporate strategies, break down the mechanics of long versus short positions, and finally, we'll read the fine print on basis risk. Part 1. Financial insurance. Hedging basics. If you're a corporate leader aiming for sheer survival and stability, we need to be crystal clear on what we actually mean when we say hedging. So, officially, hedging is the process of reducing or managing financial risk using derivative instruments. And when we say derivatives, we're talking about tools like forwards, futures, options, and swaps. But honestly, the absolutely crucial takeaway here is what hedging is not. The main goal is not to maximize your profit. If you are out there trying to maximize profit, you are doing something else entirely. Instead, your goal here is strictly defensive. You want to stabilize cash flows, cut down on uncertainty, and protect the value your portfolio already has. Moving on to part 2, hedging versus speculation. We really need to draw a hard line in the sand here because mixing these two up is easily the biggest misconception out there regarding financial derivatives. It's fascinating when you contrast these two mindsets side by side. On the hedging side, you are fundamentally trying to reduce risk. You already have a real-world exposure, like, say, an airline that simply has to buy jet fuel to operate, and you're just trying to protect that exposure. It is a conservative, insurance-like play. But contrast that with the speculator. The speculator is actively taking on risk. They don't have any underlying business need for jet fuel. They're literally just looking to score a profit based on where they guess the market is headed next. It's aggressive. It's basically betting. Remember, derivatives are just tools. The hedger uses that tool to forge a shield, while the speculator uses the exact same tool to place a bet at the casino. Which brings us to part 3, real-world corporate strategies. Theory's great and all, but let's see how the absolute giants of industry actually deploy these instruments to survive the real world. You can think of derivatives as this highly specialized menu of solutions for very specific corporate headaches. You've got futures, which are standardized exchange-traded contracts. They're incredibly common for locking in commodity prices. Think oil, gold, wheat. Then you have forwards. These are similar to futures, but they're highly customized between two parties, making them the absolute go-to tool for managing currency risk. Options? Well, they give you the right, but crucially not the obligation, to make a move. That makes them perfect for downside protection, essentially capping how much you can lose. And finally, swaps. They are brilliant for managing interest rate volatility. Let's actually look at a few of these in action.
Okay, let's walk through a classic scenario. Step 1 is the expectation. Imagine you are running Indigo Airlines. Jet fuel is obviously one of your most massive operating expenses. Let's say right now, crude oil is sitting at $75 a barrel, but your management team is terrified it's going to skyrocket to $100 over the next 6 months. If that happens, your profit margins are instantly wiped out. So, step 2, the action. Indigo goes into the derivatives market and buys crude oil futures contracts at $78 a barrel. They are essentially locking in that future price. Now, step 3, the outcome. Let's say the absolute worst case scenario happens and oil really does hit $100.
$22. Think about what that actually means for a second. Because Indigo holds a futures contract that lets them value oil at $78, while the rest of the market is paying $100, they just made a $22 profit per barrel on the derivative itself. Now, yes, the actual physical fuel they are pumping into their airplanes has gotten painfully expensive, but that $22 financial profit perfectly neutralizes the massive spike in real-world fuel costs. Their operating budget stays totally stable. They survive the crisis. And that is the magic of how hedging stabilizes a business. Let's check out another one, this time dealing with currency risk. Imagine an IT giant like Infosys. They know they've got a massive payment coming in US dollars 3 months from now, but they report all their revenues in Indian rupees. If the dollar weakens against the rupee during those 3 months, their actual revenue just evaporates without them doing a single thing wrong. So today, they enter a USD to INR forward contract. They are literally locking in today's exchange rate for a specific date 3 months down the line. That way, even if the dollar completely collapses by the time they get paid, their rupee revenue is entirely protected, uncertainty eliminated. I've got one more rapid-fire example for you, this time utilizing a swap. Say Tata Motors takes out a massive floating rate loan. Now, floating just means the interest rate rides up and down with the broader market. If rates suddenly skyrocket, their debt payments could literally cripple the company. To fix this, they enter into an interest rate swap. They agree to pay another party a fixed rate, and in return, they receive a floating rate back. Those two floating rates effectively cancel each other out, and just like that, Tata Motors has magically converted totally unpredictable floating debt into perfectly predictable fixed borrowing. It's such an elegant way to stabilize financing. All right, Section 4. Mechanics, long versus short. This is a huge concept. You see it constantly on exams, like the CFA, but it's also the backbone of everyday corporate strategy. How do you actually know which direction to take your derivative? The rule here is actually beautifully simple. The direction of your hedge is entirely dictated by the direction of your fear. You use a long hedge when you're terrified a future price is going to increase. You are longing or buying the futures. That's our airline example, right? They need fuel later, they fear the price going way up, so they use a long hedge. On the flip side, you use a short hedge when your big fear is a future price decrease. Imagine a wheat farmer. He already owns the wheat in his field, he's harvesting in 4 months, and his ultimate nightmare is the price of wheat crashing before he can sell it. So he enters a short hedge. He sells wheat futures today to lock in that high price. It's the exact same market, but driven by entirely different fears, requiring entirely different mechanics.
And now, Section 5, the fine print, basis risk. We've talked a lot about the power of these tools, but I've got to ask you a critical question here as we wrap up. What happens if the hedge isn't perfect?
This brings us to basis risk, which is a reality check every executive needs. Look, in a textbook, a perfect hedge completely eliminates your risk. But in the real, messy world of finance, perfect hedges are basically unicorns. Most of the time, you're dealing with an imperfect hedge that greatly reduces but doesn't totally erase your exposure. Basis risk pops up when your derivative contract doesn't perfectly match your real-world asset. Like maybe our airline bought crude oil futures, but they actually burn highly refined jet fuel. Sure, those prices move closely together, but they aren't identical. That gap, the spot price of your physical asset minus your futures price, that's your basis risk. You are absolutely still protected, but there's a little bit of wiggle room you just have to account for. So at the end of the day, there's a massive corporate trade-off going on here. On the positive side, hedging delivers incredible risk reduction, totally stable cash flows, and financing predictability. It lets you actually plan for the future without staring at market tickers all day long. But the downside? By locking in a price, you are sacrificing favorable market moves. If that airline locked in fuel at $78 and the market crashes to $50, well, they're stuck paying the equivalent of $78. You cap your downside for sure, but you also completely cap your upside. Plus, hedging definitely isn't free. You've got premiums, transaction costs, a steep complexity curve that requires specialized talent, and as we just talked about, that lingering basis risk. I want to leave you with one final, provocative thought. If perfect hedges are truly that rare in the real world, is your company actually protected, or are you just carrying a different kind of risk? Hedging is an absolutely mandatory survival tool, no doubt about it, but it requires constant, intense vigilance. You have to review your exposures, really understand the instruments you're using, and make sure your corporate shield doesn't have any hidden cracks. Thanks for joining me for this explainer. Keep learning, keep questioning, and I will see you next time.